Hello everyone, welcome to Atomic ACCA's exam solving series, and in this video we are going to start off with financial management pre-mock exam for June 2025 session. Generally we start off with section A in the exams. Now, why do we have section C on the screen? Because we know in the FM exam we have the exam split into three sections, out of which section A and B is unpredictable. Any syllabus area can come, while section C is very predictable, and we know the three major areas in the syllabus, which is investment appraisal, working capital management, and we have business finance. So, two out of these three topics are going to come up here. Now, I, as a student, would definitely prepare really well for these three topics because I know it's definitely coming in the exam and I want to pass the exam as well. So I'm going to definitely prepare really well for this particular session or this particular topics over here. So what I can do, I can come start with the exam over here, score all the marks that is possible from here, feel that confidence in the exam, then go with the unpredictable areas in section A and B. So this is the reason why I recommend starting with section C, score all the marks, then go to A and B. Cool. So how the section C will be split? We'll have two questions, two case studies specifically. Each case study is worth 20 marks and the other one is 20 marks. Inside the case study, there will be multiple requirements of small marks and big marks, and there will be numericals as well as theory. So it's quite important that you need to know all of these areas. Practicing the exam kit questions itself would be quite sufficient enough to score a lot of marks within the section C. So it's not going to get that complicated. So let's see. Let's begin with question number one, case study number one. We have some questions over here. Let's just give a quick read through it. We have the Excel sheet, so we can assume it's some numericals. Calculate cost of equity of star company before the expansion to appraise the new business area project. Explain your method. 3 marks. So you have to find KE, cost of equity. Theoretical exercise price of equity share of star company, assuming that the option to issue right share is chosen, explaining the calculation for 2 marks. So you have to find TERP and you have to do some explanation on that calculation. But again, it's 2 marks, so you don't have to go in depth. Weighted average cost of star company after expansion, assuming that funds are raised by issuing loan note. 4 marks. So this is going to be maybe some few more steps could be there. So 3 plus 2, 5, 5 plus 4, 9. We have 9 marks worth of numericals over here. And which topic are we dealing with? We're dealing with business finance now. So let's just give a quick read through the case study what we have here. Star Company, a listed company engaged in manufacturing and selling of home appliances. It distributes the appliances through its own retail showroom established all over the country. Company is currently all equity financed, which means there's no debt. Okay. So it could be a family business or something, anything. It could be whatever. Globe Company is engaged in a different business that Star Company is considering as a new project. So Star Company is considering some new project and Globe Company is operating in that different business sector. Its current capital, it means Globe Company. Its current capital structure comprises of debt to equity of 50-50 and its geared beta is 0.85. Where do we use this beta concept in calculation? When we do CAPM calculation. Alright. So we have debt to equity. So we have the capital structure and we have the geared beta. Geared beta means asset beta or equity beta. It will be equity beta. Cool. So that is okay. Then shares of Star Company are currently trading at $5. Star Company means that original investor. Okay. So Star Company is having share price in the market for $5 and there are 200 million shares outstanding. Okay. For the year ended 31st December X4. We don't have any year before that. Okay. For year ended earnings before interest and tax, EBIT, or we can just replace it with PBIT, operating profit, stood at 66 million. Its PE ratio is currently 20. Okay, it's a listed company, so it's quite understandable that they can obtain their PE ratio. That's fine. EBIT is estimated to grow by 20 percentage. That is, this 66 million would grow by 20 percentage due to the expansion into new market. Okay. For further expansion, Star Company, okay, new market. Okay, that is this thing, new project. For further expansion, Star Company is contemplating to invest 200 million. After some discussions in a board meeting, the following alternative source of funding have been identified. Number one, they are making a rights issue, right share, to raise 200 million by issue of sufficient number of right share at a discount of 20% to current price. So current price is $5. They're planning to give it at 20% below this. Then issue of 6% loan note at its nominal value of 100. Pre-tax cost of debt is estimated to be 6% and the PE ratio will remain unaffected by the debt issue. Equity beta will become 0.579. Why the equity beta will change now? Because previously this company, this star company, was completely equity financed. Now when you're issuing a debt, what happens? Debt comes into the capital structure. Debt is something that will increase the financial risk of the company. So what will happen? Automatically the equity beta will change. So the equity beta that you have here and the equity beta somewhere over here in the initial stage will definitely be different, right? Corporation tax rate is 25%. Risk-free rate of return can be assumed at 4% and the estimated market premium is 7.5%. So these are generally the CAPM formula items that we have to use. So let's get back to question number 1. What did they ask? They're asking what is the cost of equity, KE, of star company before the expansion to appraise the new business area project and explain your method. Now, if I want to find the star co figure, okay, generally this is also one more thing that you can note. Generally these requirements will be given in a way where most information related to question 1 will have to take from the initial part of the paragraph. Most information related to question 2 will be somewhere in the middle of the paragraph. Most information related to question 3 will be at the end of the paragraph. It's not mandatory that it has to be like that, but then it is generally a trend that you see in the question paper. Cool. So with regards to this cost of equity for star company, what information we have? Now, can we make this big? Okay, we can scroll it down. Cool. So this is A1. What is it? Yeah, A1. So A1, that is cost of equity of star company. Now, how can we calculate cost of equity? For calculating cost of equity, we have the DVM model or we have the normal CAPM model. Now, we don't have any information about dividend payouts or anything given over here. That means it's understood that the DVM model we can't use over here. So, what we have to use? We have to use the CAPM model. What is the CAPM model? CAPM model says that we can take the risk-free rate plus equity beta of the company multiplied by the risk premium. This is how we can get the CAPM. I mean, we can get the cost of equity from this one. Now, risk-free rate, we found that it is somewhere over here. Risk-free rate is there at the bottom. RM minus RF, the risk premium is also given over here. So now I need to find the equity beta. All right. Now, if I want to find the equity beta, okay, we are not calculating what is the cost of equity currently. We are using this cost of equity for what? For the purpose of use in appraising the new business area project. If in case I'm using it for the new business area project, what I have to do? I have to find the equity beta of that industry. How do I find this? I have to take that proxy company's figures. There is some equity beta given over there. I have to remove their financial risk from this, get the asset beta, then re-gear it with my own financial risk, which is star company's financial risk, get the new equity beta, which is going to incorporate that risk element. This equity beta is what I will utilize in my calculations here so that I can get a KE, cost of equity, to use for appraising that new business area project. So we got the overall idea over what we have to do as steps. We have to do the CAPM calculation over here. For that, what we can do? What we can do is we can take this globe company's figures and de-gear it. What is the globe company's figures we have? Globe company, which is basically the proxy company. The figures we have is its current structure is 50-50. So value of equity we can take as 50, value of debt also we can take as 50. Then we have the equity beta, geared beta. So BE is given, that is equal to 0.85, and the tax rate was also given. Where was that? Tax rate is given 25%. What is the de-gearing formula? de-gearing formula is we're going to find the asset beta, meaning the without the gearing part, beta equity multiplied by value of equity divided by value of equity plus value of debt into 1 minus tax rate. Okay, so this is what our formula would look like. Now let's incorporate these numbers over here. Beta equity is given over here multiplied by value of equity, that is the numerator, so I'll just put a no need to put a bracket, it's fine, we'll put brackets for denominator, value of equity plus value of debt multiplied by 1 minus t means 1 minus 25 percentage, which means that will be 75%, so I can just take it directly. So value of debt into 75 percentage, this one I'm going to add it with the value of equity, and that whole thing I need as a denominator. Did the bracket come up automatically? We have a bracket here, and we have this inside a bracket, and we have this whole thing inside a bracket, and that's the denominator. So we have the beta asset over here. So we got the asset beta. Now what we have to do, we have to re-gear it. When I'm re-gearing, I need the capital structure of star company. What is star company said as? All equity financed. If it's all equity financed, and if you look at the formula over here, let's say if I do the formula once again, value of debt is basically 0. That means my 0 into 1 minus t means it will be 0. So what we have left with, we are left with value of equity by value of equity, which will cancel out. That means it will turn out to be 1. That means beta equity into 1 is equal to beta equity. So if I solve out the formula, what will I be left with? I'll be left with a solution where asset beta is equal to equity beta. So if in case anyone has learned this thing by heart, stating that whenever you have an equity finance thing, then asset beta is equal to equity beta. If you were simply by hearting this thing without knowing what is the reason behind this being equal, just simply solve out this formula, applying value of debt equals to 0, and see what answer you'll get. You'll be ending up with the same solution. So that is the explanation for why asset beta and equity beta is same. Being said that, since the company is all equity financed, asset beta will be equal to equity beta. Cool. Hence new BE is equal to 0.485. Now that is sorted. Next thing, what we have to find? We have to find the new cost of equity, that is the CAPM. So for that, risk free rate we have to take at 4% plus, I'll just write over here, risk free rate is 4%, RM minus RF is equal to 7.5 percentage. So KE will be equal to RF plus beta equity into RM minus RF. That is equal to 0.076. That will be equal to, if I take this one into 100, I'll get the answer as 7.642. So I can say the 7.43 percentage, that will be cool. So that will be our answer over here. So if we have to just, they told explain and write. Okay, so we have the calculation over here. We can just write few a number, because all the numbers over here, I just have to do few explanations over here. What I can do is, whatever number work I've done, I'm just going to explain it in few words. What I can write over here, using CAPM, cost of equity can be found. For this, Globe company can be de-geared to find asset beta. So we took Globe company's information, we de-geared. After that, what we wrote, since company is all equity finance, asset beta will be equal to equity beta. Then we found what is equity beta. This figure can now be utilized within CAPM formula to find cost of equity. Then find the formula, apply it. That's it. So this calculation is over. What was next calculation? Next calculation was to find out what is the theoretical X rights price if in case they're going with that rights issue. So that was for 2 marks, so you don't have to work too hard on this. Uh, this is question number 2, and now we are going to find theoretical X rights price. How we are going to find theoretical X rights price? First, we need to find how many right shares we are giving and what is the rights price. How many existing shares are there? What is the existing share price? So we're going to multiply these things. We're going to find a total for this one. So we'll get a total over here. We'll find the total for this one also. How many shares are there? Then we are going to divide the total value divided by total number of share to get like an average price. That's called TERP. So now I have to find out what is the figures required over here. Okay, what numbers I have to use over here. First thing, the company wants to raise 200 million shares. I mean 200 million amount. So amount total finance required is equal to 200 million. What is the share price that we are giving at? Existing share price. Existing share price is equal to $5. At what price are we giving? Rights price. Rights price is given at 20% below the current price. That means equals to this one into 80%. That is $4. If I need 200 dollar, no, how much? $200 million, and I'm giving it at $4. So how many right shares are to be issued? Right share issued will be equal to 200 million to raise divided by $4 per item per share. That will be equal to 50 million shares I have to issue. So for 200 million, how many shares were there in the company? Somewhere it was there. Yeah. Company currently has 200 million shares outstanding. So company has currently 200 million shares. Rights shares to be issued is equal to 50 million. For 200 million shares, if I'm issuing 50 million share, then if I'm issuing one right share, for how many existing shares will it be? What is the proportion of this one? 1:4. That means rights shares, no, hence the proportion of rights share issue will be 1:4. Maybe that's, oh, what is this? Oh, it came as time. Okay, I'll just write 1 over here. Oh, okay, forget it. Just write over here 1:4. Okay, now how we are going to do the calculation? We're going to apply this thing into our format. So one right share is issued at $4. Four existing shares have an existing market price of $5. The total will be equal to 1 into 4, and this will be equal to, I can just copy paste this thing, 4 into 5, 20. What will be the total of this thing? Sum of these two numbers is 5. Same thing if I copy over here, sum of that will be 24. So what will be the TRP? Total price divided by total number of share, that is equal to 4.8. This is called the TERP. For 2 marks, that is totally enough, so you don't have to write too many stories for that. This is totally fine. Now what we are left with, we have one more question, third question, that was asking for what? Oops. Third question was asking for weighted average cost of capital, WACC. What is the format for weighted average cost of capital? That is equal to proportion of equity multiplied by cost of equity plus proportion of debt multiplied by cost of debt, post tax cost of debt. So the idea is very simple. Whatever different finances we have, we need the proportion of that, we need the cost of that. The next finance, proportion of that, cost of that. Next finance, proportion of that, cost of that. So this thing we just keep on repeating. If you have 10 finances, we are going to repeat this 10 times. This is the key idea over here. Cool. What is the question asking? Question is asking What find the WACC of star company after expansion, assuming that funds are raised by issuing loan notes. That means company currently has sources of finance. Company currently is all equity finance. That means equity is one finance. Next thing they told that they are issuing loan notes. That means debt is another finance. Loan note. I need to find what is the proportion of equity, what is the proportion of loan note. Then I have to find what is the cost of equity, what is the cost of loan note. Simple. So four things I have to find out. Now, in order to find the proportion, what do I need? I need the values, meaning market values for each of it. So four things I'm going to find: value of equity, value of debt. So total of that, when I divide it, I'll get the proportion. Then I need cost of equity, then I need cost of debt, 1 minus t, which means I need the post-tax cost of debt. Four things to find. All right. So let's start with the equity part. Equity. What is given? I need the market value of equity. That is quite straightforward. We have 200 million shares currently in the company. They are trading at $5. So when we multiply it, we get the market value. So value of equity will be equal to 200 million into 5. So that is sorted. Next thing, I need to find cost of equity. Can we use DVM model here? No. So we have to still stick on to the what is that? CAPM model. Cost of equity. KE will be based on CAPM model. What is CAPM model formula again? RF plus beta equity into RM minus RF. RF we have, RM minus RF we have. Equity beta we need, which is already given over here. The equity beta will become 0.579 post issue of loan note. So because it is directly given, I can just apply it over here. RF was 4 percentage plus beta equity will be equal to 0.579 multiplied by Rm minus Rf will be 7.5. That will be equal to 8.3425. So we have value of equity, we have value of, cost of equity. Next thing, for the debt or the loan note, we can call it. We need to find the market value of the loan note. We need to find the cost of debt. Okay. Value of loan note. How much loan notes are we raising? We are raising 200 million. Not that one. Where is it? Yeah, we want 200 million to invest. That means loan notes are going to be 200 million in total. So that was straightforward. 200 million. Then we need the cost of debt. We need post tax cost of debt. That will be equal to what is given over here. They are issuing 6% loan note, and the pre-tax cost of debt is 6%. So that's given over here, pre-tax rate. So if I want to take post-tax rate, I have to minus out the 25%. That is 1 minus 25. That will be equal to 6 percentage multiplied by 1 minus 25 means 75 percentage. That is equal to 4.5 percentage. So we have value of equity, cost of equity. We have value of debt, cost of debt. Now let's apply it into the WACC formula. How do we get the WACC formula? We're going to take the proportion of equity. How do I take the proportion of equity? There's an easier method. We can just create a small table for this. Value, cost. Okay, this will be our headings. Then we can write the sources we have. We have equity and we have a loan note. What is the value of equity? Value of equity is 1000. What is the value of loan note? Value of loan note is 200. What is the cost we have? Cost of equity is 8.3, this one. What is the loan notes we have? Loan note cost is this one. Then what we will do is we will sum up the values. So we have the total value over here. Next thing, we have the cost over here. This is also sorted. Now what we will do is we'll apply it to the WACC formula. How we are going to do it? WACC formula is equal to, first thing, proportion of equity. What is equity? 1000. 1000 out of 1200. So that is the proportion of equity multiplied by cost of equity. How much is cost of equity? 8.34. Bracket close. Open. Next bracket. Proportion of debt. 200 out of 1200. multiplied by what is the cost of debt, post tax cost of debt, 4.5. Close the bracket. Now we have all the things ready. Hit enter. We have the figures ready. So how much we have? 7.702 percentage. This will be the WACC for this particular question. And with that, we are done with all the numericals that's required for the question number A123. All sorted? Cool. Next, let's go to question number 2. Evaluate the possible impact of each of the following method used on the wealth of shareholders and comment on the acceptability of each method. Now, this is a common thing that we see even in the exam kit questions where when we have multiple sources of finance, we find out what is the impact of this. What generally we will find out is how the share prices are going to move based on this thing. Okay, so let's if we had an Excel sheet, this would be easier to present. But anyway, since we don't have an Excel sheet, let's just use a table. How we are going to do this is we are going to find what is the current situation, what is the situation with share issue, right share, what is the issue with loan note. So that is the three methods we have. And what we generally do is to find the share price. We have this layout we learned in class. We just use a simple layout with the SOPL, meaning the things that we have. We use the concept of PE ratio, EPS, and everything. Our end target is we need share price for everything. Okay. So we are given with the EBIT over here. So that will be a starting point. This is what we generally see in the questions. So PBIT, finance cost, PBT, tax, PAT. After PAT, what we are going to use? We generally have the figures like the number of shares we will have. So we'll take that later on. First, let's fill in these numbers. So this is our table. Okay, go away. Okay. So, okay, we'll just add one more to write the title. How do I add one? This is called column. So this is row. Okay. Insert row after. Okay. So this is the current scenario. This is the rights share scenario. This will be the loan note scenario. What is happening over here is we're going to take, oh, we need the titles also, right? So how do I add one column? Column before. Okay. So we're going to write PBIT. Then we're going to minus out interest. Then we will get PBT. Then we're going to minus out tax. Then we will get PAT. What is PBIT? PBIT currently is trading at, no, not this one. Where is it? Earnings before interest and tax stood at 66 million. Currently, it is 66 million. If they are investing somewhere and the project and whatever happens, next year, EBIT will be equal to 66 million. No, that is current year. PE ratio is 1. EBIT is estimated to grow by 20% due to the expansion into new market. So EBIT will grow by 20%. So that will be equal to, we'll use the calculator here. 66 million into 20% growth means into 1.2. That will be equal to 79.2, correct? Yeah. So that will be 79.2 here. So regardless of how I expand, I'll still have 79.2 as my PBIT. Next thing, interest. Currently, the company is all equity finance, so I'm not paying interest. If I'm issuing right share, I still have no interest to pay, 0. If I'm going with a loan note, I have an interest to pay. How much? We are raising 200 million amount by the loan notes, and we are paying a 6% interest on that. One question: do we have to take pre-tax or post-tax? We have to take pre-tax. Why? Because you can see from the SOPL, interest comes up here, and after that we are going to pay tax on that. That means that figure will change. The what you get, the total figure will come up later only. So we take the pre-tax figure over here, that's 6% itself, and remaining it will get impacted on that. So we have 200 million multiplied by 0.06, that is equal to minus 12. That is the interest we are paying. So what will be the profit before tax? Here it will be 66, here it will be 79.2, and here it will be how much? 79.2 minus 12. With an Excel sheet, this should have been a lot easier, but they just made our lives too difficult. So 79.2 minus 12 is equal to 67.2. Okay. Now what is the tax rate? Tax rate is given at 25%. It's not mandatory that you have to show the tax rate. You can just directly go to the PAT, because our result is not about showing how much tax is there. We want to end with the result, how much is the impact on share price. So let's just go directly into PAT. 66, if I minus out 25%, it will be 75 percentage. So 66 into 0.75 will be equal to 49.5. 70, how did this become different? Okay, this is after growth. Okay. So 79.2 into 0.75 will be equal to 59.4. Then over here we have 67.2. So 67.2 into 0.75 will be equal to 50.4. Okay, now we have all the profit after tax over here. Next, what we are going to do? We are going to find out. Oh, it's not going down. How do I go down? Okay. Okay. Next thing we have is in the table, what we will write is we'll write the number of shares we have. Then we will find out what is the EPS, PE ratio, share price. This is not a new concept or anything. If you have gone through the exam kit, or if you're my student, we have done this thing in the class as well. We have shown this repeatedly, generally in many questions. So the same layout we follow everywhere. Whenever this financing method question comes up, like multiple finances are there and what impact is there, the same thing we do. We just see what is the impact on share price. So what tables we need now? We need the table for the title will be there. Then 3 columns we have. What all we need in the title? We need the number of shares. We need EPS. We need PE ratio. We need the new share price. Okay. So we can. Oh, why did this come up here now? Okay. So once again, title 1, 2, 3. Then we need number of shares, PE ratio, EPS, new share price. Okay. So okay. Impact on share price. So we're going to have number of shares over here. Then we will have EPS over here. We're going to have PE ratio over here, and we're going to find the share price. So what is number of shares? Company initially had 200 million shares. With rights shares, we told that 250 million shares will be issued. So 250 million will be there. With loan note, we are just issuing loan notes and not shares. So that will remain at 200. So what will be the EPS over here? EPS will be, well, in the first case, it's not mandatory to find out. We know the current share price is $5, so that is not needed. We'll just you see what is happening over here. Okay, so calculator. So we have 250. No, oh, no, no. EPS is equal to earnings by shares. So 59.4 divided by 250. 59.4 divided by 250. That is equal to 0.23. So just write over here 0.237. And PE ratio in the question was it? PE ratio is currently 20, and it's mentioned that it's unaffected by the debt issue. And with this one, we generally, even if it's not mentioned, there's a default assumption that we take. PE ratio doesn't change. But if in case they mention exactly that PE ratio is changing by so and so figures, then we have to take that. But by default, the assumption is PE ratio doesn't change and it stays at 20. So currently also it is at 20. We are just assuming that it will not change. So that will remain at 20. So here the EPS into PE ratio, we have this formula we have for share price. So 0.237 into 20 will be equal to 4.74. And here, oh, we didn't find the EPS over here. So that is 50.4 divided by 200. That will be equal to 0.252. And over here, the answer into 20 will be equal to 5.04. So what is the situation that you can see with the share price? You can see that currently share price is at $5. If you're going with the right shares, which is at discounted value, the share price turns out to be 4.74. And if you're going with the loan note, you can see that the share price seems to be increasing beyond $5. From the investor's point of view, which is the most important, what is the question asking? Evaluate the possible impact of the financing method used on the wealth of shareholders. So we can find the wealth based on the share price. Then comment on the acceptability, which one is good or bad. Okay. So now let's write the stories for this. How do I go down? Okay. Okay. So let's remove this calculator. Now let's write stories. First thing we can say the impact on shareholders. We don't need a heading. We can just, but it's important that you be careful with the conjunctions. Okay. You have to address all the parts in the question, but not mandatory that you have to write it in different headings as such. So firstly, currently the share price stands at $5. Issuing rights shares causes the share price to drop to 4.7 to dollar 4.74, while loan notes causes a rise to dollar 5.04. This clearly shows that loan notes would be preferred by shareholders. Now in FM, whenever you give a conclusion, it's always advisable, suggested. Don't give a one-liner conclusion saying it's positive or negative. Just add another point as well. If it's, let's say you've said positive, then write a negative point as well. So you're neutral in your analysis. Always know that evaluate doesn't mean that give a final conclusion. Evaluate means talk positive and negative. So whatever the verb is doesn't matter. Just say a positive and negative point somehow. You'll always get that, a positive and negative point. Tell that and conclude it so that you're staying neutral in your answer, and that's a good quality in your, to show that professionalism in your answer. So now we have said that issuing loan notes is better. So what do you have to say? Tell something bad about loan note. What you can say? But it must be kept in mind that issuing loan notes is a debt that attracts compulsory interest payment and increase in financial gearing for the company. That's enough. You don't have to write too much stories or anything. That is totally enough. So what you have written a positive part about loan note, share price is increasing, but you've also told about the negative part about loan note, financial gearing would increase, and also you'll have a compulsory interest payment from here on. Done. So that is fine. Is it done? No. What are they saying? Impact on shareholders, we told, and acceptability of each method. So now you have to say which one we can go ahead with, like a final conclusion. Now one we have to give, because they told no acceptability of each method. So we told, okay, collectively we have told over here issuing right share is going to be 4.74, while loan note costs a rights to. So this clearly show that loan note would be preferred by shareholder, but it must be kept in mind that issuing loan note. Okay, now let's talk something positive about issuing of share also, so that we have from both ends. We told the current situation, we told what is bad with loan notes. Now we can tell what is good with issuing shares also, or good and bad also you can say, so that you address this part a little more clearly. So though issuing shares may drop the share price for the time being, you can see something over here about profit after tax. 50.4 is profit after tax over here, while 59.4 is the profit after tax here. from profit after tax you can pay out dividends. That means even if share price is dropping, investors can get returns in form of dividend. So you can mention that though issuing shares may drop the share price for the time being, this leads to a higher profit after tax than loan notes. Hence, the loss made in capital can be recovered through a higher dividend payout with higher profits made by the company. So now we have told positive and negative for both. And with this, our final evaluation for this question is also done. So keep in mind of the structure always whenever this financing impact question comes up. Don't think a lot. The structure if you create, you'll get all the answers that you need. Plus, always keep in mind of the conclusions to write, positives and negative, especially when the verb used in the question is evaluate. Final thing to take from this question, always keep in mind of the conjunctions used in the question. You have to address every requirements in the question. Cool. So last question was 9 and this is 7, so we're not done. I think we have one more question. See, discuss the various assumptions related to the capital asset pricing model. So the question is for 4 marks. Now theoretically we have a lot of, you know, lot of assumptions that are used in that calculation. For example, if you don't want to uh, remember a lot, from theory point, what I generally do is I know the calculation how CAPM works, so I'll just create the structure in my mind. Okay, calculation begins with de-gearing, then goes to re-gearing. What all things are included in it? Beta is included. What assumption is there for beta? Then initially we de-geared. For that, what did we use? We used a proxy company. What assumption is there with proxy company? Then finally we got into the CAPM formula. In CAPM formula, what we use is RF. What assumption is there with RF? Plus beta equity? Beta we already told. Then RM minus RF. Where do we get this RM from? How do we get the risk premium? Like this, if we go through the formula itself, we get all the assumptions that's needed. Considering that this is 4 marks, we're going to use the same technique now. We're going to go through this formula, see at each point what assumption is there, then write a story on that. I mean, not story on that, a small explanation on that, and that is going to be enough for our discussion over here. All right, so the various assumptions used in CAPM are as follows. Where did we start with? We started the steps with de-gearing. What did we told over there about proxy company? So we are going to just write the title proxy company. Now for the CAPM calculation, where for the CAPM calculation, when when business investment happens in a new sector, for CAPM calculation when business investment happens in a for CAPM calculation when business investment happens in a new sector, a proxy company is utilized to reflect is a proxy company is utilized for calculation purpose where removing the company's financial risk, meaning companies de-gearing means removing financial risk, will exactly will give the business risk of that particular industry. CAPM assumes that this proxy company's business risk will exactly be equal or exactly be similar to that of our new investment, but it doesn't take into consideration the size or activity of that proxy company. Why? Because if the proxy company is a large ideal company within the industry, while the investment project we move into is a small one, there definitely will be a difference in the business risk for both. Cool. So now we told what is the assumption with proxy company. Next, what comes in the format? We have this value of equity, value of debt. Now there's no assumptions in that. That's quite understandable. We can get the figures easily. But what else is there? We have this equity beta. So this concept of beta factor. Okay, beta. Betas are used to 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 reflect the risk element of the business sector. Okay, risk element of the business sector and the finances, financial and the financial risk. Though financial risk may stay the same if capital structure doesn't move. Though financial risk may stay the same if capital structure doesn't move, the business risk will keep varying from time to time based on market changes. Hence, the beta used today providing and the beta used today for CAPM calculation may end up giving a different answer if calculated in a future period. Cool. So beta is unstable. That is another problem. Third one. What else did we go in through the formula? We told about proxy company. We told about beta factor. We told about CAPM formula. RF, risk-free rate. What is the concept of using this risk-free rate inside the CAPM calculation? The idea is risk-free rate is like the bottom figure. What we are looking at is we are adding on top of that the market premium, and we are multiplying that with the with the figure called as beta to incorporate that risk element. First of all, why is this risk free rate used? Because most theories, even CAPM is based on a theory how we get into this calculation. Almost every theory in finance, we know that it is based on this concept called perfect capital market. What is perfect capital market? A hypothetical market in the world which does not exist, where there is no transaction cost, where there's no taxation, where every investors are rational, where every investors are having same information about everything and they react to everything in the same way, which is not practical. That's why it's called a hypothetical scenario. That is also one one assumption of CAPM model that maybe we can write as the next point. So I told one whole thing over here, maybe we can write over here. But along with that, connected to this, we started off with risk-free rate. Connecting to this capital market, the concept behind this risk-free rate being used in this calculation is that CAPM assumes because there's a capital market existing, every investors can invest and borrow at the risk-free rate. This risk-free rate, not everyone can invest over here, and not everyone can borrow at the same rate, because when you borrow, credit rating will apply, the market rates will apply. So, and depending on the tenure of the loan that you're planning to borrow, based on the amount that you're planning to borrow, these figures will keep on changing, which means not everyone can invest or borrow at the risk-free rate. But the company, or I'm sorry, the CAPM model assumes that everyone can borrow and invest at the risk-free rate. This is the assumption over here. Now, that much of an assumption, if you want to know, that's a little bit of logic. So, as I told, it's not that if you go through the format, you can think and figure out all this information. You need to know all these things. It's just that you don't have to by heart everything. You can find information from the formula. So, this is just a technique to find. This is not like the ultimate solution where all the answers would automatically pop up in your head. Okay. So, risk free rate. What is the assumption? CAPM model assumes that CAPM assumes that all investors and borrowers can invest and borrow at the risk-free rate, assuming the existence of a perfect capital market. So let's write that point as the next one, perfect capital market. It is a hypothetical scenario where no transaction cost or taxation exist. It all assumes all investors have exactly same information and reacts to everything in the same manner. Most theories in finance is based on this assumption of perfect capital market, but in reality it does not work. In reality it does not work. Cool. Okay, so we're done with 4 points, and that is the end to this particular question. I think we're done. Okay, we have the 20 marks title over here. So with that, we are done with case study number 1, and hope you have followed with the start of our FM paper. So we are confident with our first answer. If not everything is correct, for example, let's say if not everything is correct, I still have good amount of marks over here. If let's say the theory completely went wrong, I don't care, doesn't matter, because I'm good with the numericals. I've seen those numericals back in my exam kit when I was preparing. I'm seeing the same thing over here, or maybe in your actual exam it could be a slightly different. But always remember, your final answer is not the marks, your steps are the mark. So for example, even if this proxy company, let's say half of it is correct and let's say the second half is wrong, doesn't matter, that's first half I'll get marks, and collectively when I take little bit marks from everything, I'll pass. That is more than enough for me. I just need to pass the exam. Cool. So with that, we're done with first question. We have a lot more to come in because we're just done with 20 marks and we have 80 marks pending, so don't lose focus yet. We're moving to question number 2 in section C. So see you soon in the next video.